Hey everyone, Hans from Crush the Premium here. So today our trade idea is Amazon, and we're going to dive into it a little bit. This is something that we have on in the community from a little while ago, but I think it really still looks good. Getting into the community is done by doing one of the programs, and then you get into the Discord, which has incredible features all around. This is part of the ecosystem of Cashflow Insiders and Crush the Premium. So look into it if you're interested. So Amazon looking really good, right? So from a fundamental basis, we always like to have a story. We like to have a narrative. They continue to be the gorilla in the e-commerce space, right? So a little bit like Meta, which I've also been pounding on the table about all year, right? And again, hitting all-time highs today. These are really sort of immediate beneficiaries in AI. And the funny thing is, these have been leaders in AI really from like 12, 13 years ago, right? These have always been the guys amassing these massive amounts of data and using it to figure out how to sell us stuff, right? How to sell you stuff that you need or don't need. And it's just getting better and better with advertising, and advertising really starting to affect Prime Video. It's exploding. And Jassy came out, he said, they're really just starting to scratch the surface in the video advertising space. And I believe that's really true. You sort of look at it, if you break it down, they've got more NFL games, they've got NBA games, they've got all these other special events. So even outside of their regular programming, movies and TV shows, really a formidable competitor to Netflix, but in a very unique way, right? They have this incredible opportunity to tie in e-commerce to TV and entertainment and gaming even. So as all these worlds collide, the revenue stream possibilities are amazing for that sort of ecosystem that Amazon is developing. And Prime is really contributing to that ad business a little bit like Netflix did, right? They came out with that paid tier, which is a little bit cheaper. And that, that's fine for people. They don't mind ads, and some of them don't want ads. Well, with Prime, if you don't want ads, you can pay $3 a month. But if you want ads, then fine. You get your Prime anyway with your Prime membership. And so it's sort of a win-win either way for these guys. But the advertising side, they probably rather that you pay less or nothing and just your Prime membership and get all the advertising, because this is getting bigger, right? The Amazon advertising platform is now the third largest advert platform in the world. So incredible potential there when you really think about it, with all these different angles of new revenue streams coming about. And then enterprise to EBITDA, just to make things even better, it's 18. That's the cheapest Amazon has been in years, right? The 10-year median for enterprise to EBITDA is 30. Right? And so this kind of brings me back again, just as an aside, don't count out some of these mega cap names, right? We're talking about broadening. I've been pounding the table on broadening for months now, and it's been playing out massively. And I still think it continues, but broadening is a little bit of a show me later narrative, right? As rates come down, so many parts of the economy are bolstered, of employment are bolstered, but that takes a little bit of time to kind of filter through the economy. But we're seeing it happen, right? Small business optimism is actually starting to break out, and rates have just started to come down. So, the table is set for some amazing things in the broader economy, but MAG is still relevant because, number one, it's a show me now narrative. So as we wait for other things to develop and improve, and we're seeing some warnings from certain companies, right? So there's some issues out there in the economy, and certainly some of it is idiosyncratic, and like a FedEx, well, there's sort of unique problems there. But on the MAG side, these guys are still driving earnings right now, not later, right now. They're really where a giant chunk of the earnings are in the index. And so they're not that expensive to growth, right? So if you look at Amazon's PE to growth ratio, it's actually 21% lower than its 5-year average. Right, so these are not expensive. This is not what you call some sort of bubble where they've kind of overreacted. Now, of course, stocks can go down. On August 5th, we saw these stocks. Amazon went from 187 down to 150s. So it got into the 150s. So of course, stocks can go down. But we're trying to develop a thesis here for solid fundamentals, solid potential from a real world standpoint, and then we can get into the technicals and some of the fun option stuff after that. So really, I think a very interesting name. So let's take a look at the chart here. We've had a nice That was the dip that I'm talking about, 152. It's come all the way back, broke through this trend line, and really it's been a little bit choppy lately, but that's what markets were like last week going into FOMC and option expiry. So this was all kind of craziness, but look at that. It was trending up even though it was very, very choppy. So starting to look pretty good. We want this 50-day to stay above the 200, right? Which I think is going to happen. We've got a nice, very, very positive MACD here, looking really good. Maybe just a slight bit overextend, but looking pretty good. We've got an RSI that's starting to push towards 70. So would I like this to kind of backfill a little bit into the 185 kind of range to get some? Yeah, so if I were to put on a position on this, I would maybe put on a half position now, look for a little dip to maybe add to that. But I think Amazon really could be heading to 200 and far beyond that. So let's take a look from the option side of things. Okay, so first of all, we can see the our MTI, which is our proprietary system that we teach and give you. We give it to you in Thinkorswim or TradingView. You get this in the program. So we've got our MTI. We've got 4 green. It can go up to 5 green, but it's only being dialed back by our volatility metric here. That's pulling it back to a 4, but really it's a 5. And I would say Amazon isn't really respecting broader market at this point. It's looking pretty good. It did pull back in August, but this is a stock that wants to go up. So it's a 4, could be, you could almost see it as a 5 from a relative strength standpoint. It's doing fantastic. Not as good as a Meta, but doing fantastic. Those are really 2 great names. Let's look at the IV rank. So we've got implied volatility very, very low. So this is very interesting because we're looking at option pricing, at least from a short-term standpoint, being quite low. And that's going into potentially a high seasonal sort of high volatility kind of regime. And then we've got the election coming up and all that. So the interesting thing about some trades right now is we are seeing kind of low volatility. So if you believe in this climbing the wall of worry narrative, which I believe in, I think we kind of push higher in a measured way towards 6,000 towards the end of the year. Then it's kind of nice when you've got option prices this low, you can potentially put on some pretty cool trades to take advantage of that. Now, the first thing I want to take a look at, though, after this is skew. Okay, so here's your Amazon skew. We're looking at 30-day skew. So what this means is the price. So if you look at 0.5 means the at-the-money options, right? So these are at-the-money puts and calls, 50 delta, as you can see. And this, even though it says 75, that means a 25 delta out of the money put. And this here means a 25 delta out of the money call. So what we can see here is we have this sort of favorable skew if you like to play the upside. You have an inverted skew. Well, it's kind of a normal skew, right? In index, we always see out of the money puts more expensive than out of the money calls. So this is very similar to what we see here. So this is the 52-week average of skew. Sometimes I like to look at the 52-week average and see where we are now just to kind of see, has this changed very much, right? Is the skew steeper? That could represent doing things a certain way. Is it less steep? Is it flatter? Then that brings into view some different kinds of structures depending on your view of things, right? These are some of the things that you learn, is that depending on skew and volatility and the way things are, there may be different ways to express, I think Amazon's going up. There may be a better way to express it depending on some of the things that we're talking about here. So you always want to obviously give yourself the best odds and pick out the most favorable structure, whether it's a long call spread, whether it's a short put spread, whether it's a risk reversal, or just long some options. Could just be long some options, right? So we can see here that we're quite a bit lower right now, which we saw on the other chart. We have implied volatility quite a bit lower. We have Amazon kind of pushing. Funny, last week from the Thursday to the Friday, we actually came down. So we had that massive move up on Thursday in the whole market, and volatility actually rose in a number of names. And people wonder how that happens. Well, upside volatility is still volatility. So remember, when you start getting huge upside moves, like we saw that day, you're going to have volatility kind of hang in there a little bit, because we tend to think volatility drops when stocks go up. But if they keep going up, or if they move up strongly enough, everybody realizes, the vol markets realize, well, that's still movement, that's still significant movement, and we're not ready to bring down the VIX accordingly. So sometimes on a very extended, strong move up, you're going to see volatility hang in there because everyone's kind of thinking, well, we're probably due for a pullback, and they kind of maintain that volatility. So we saw it pop a little bit here today, probably a reflection of some weekend dynamics as well. So nothing really to consider there. Typically, we get that weekend effect. They crush volatility on the Friday, and then it pops up a little bit. We see that in the VIX. It pops on Mondays a lot of the time, and that doesn't mean the market's worried about anything. That's called the weekend effect, which I'll do a video on as well. So we see maybe a little bit of weekend effect here because I don't see Amazon doing anything, so it has nothing to do with what the stock is doing. It's just part of how the weekend plays into volatility. So we have very cheap vol, and we have puts that are actually cheaper, or more expensive rather, than calls. So right now, a structure that might make sense is selling an out of the money put and picking up an out of the money call, which is what we have in the community. We have it quite a bit lower. We put it on for almost even money, and it's up quite a bit of money now. I'm sort of targeting 200. I don't want to get rid of it right now, just because I'm still quite positive on the name. And I think we just kind of continue to drift up and climb that wall of worry, as I like to say all the time. A lot of de-risking in technology over the last couple months, a lot of hedge funds getting out of technology. There's a lot of money that needs to come back in. And we just talked about how relatively cheap Amazon is, and a few other names. They're going to have to take another really, really good look. So I'd be surprised if big funds aren't kind of sitting below the bid on names like this going, okay, show me a sell-off, I'm ready to start buying again. So they're either buying now or they're sitting back and may not allow these things to drop very much. So while I would like to see maybe a pullback to 188, 187 to get into more of this, I'm not sure it's going to happen. Anything can happen. Again, anything can happen, obviously. So this is going to make a couple of structures look interesting here. If we were to look at skew, which we can do depending on the expiry that we use, which is a really, really cool feature here. This is called Market Chameleon. Excellent features. And this is in my list of sort of must-use tools when you do this stuff. And we can see that's kind of positive sort of upside risk reversal potential, which means selling that expensive and buying the cheap. Selling expensive, buying the cheap. It kind of looks really good. Very typical. This is what SPX is going to look like, right? S&P 500 looks like. This is sort of your typical skew, and sometimes they push down that upside a lot, right? Because you get, especially last Friday, you get people, you get covered call funds and people who've sort of sold a lot of calls to generate some income on positions, right? This is a very popular strategy, and they buy those back and then they roll up, right? So what we saw on Friday is a lot of positions got rolled up in Meta and a few other names where, say, the strike was 190, now they roll that position up to a 200 or a 210 or a 205, and what that does is it frees up the upside a little bit, because when we talk about gamma, we talk about how those large gamma positions, those large option open interest positions can often put a clamp on the stock. That means there's a lot of supply of stock around that strike and above the strike. When they move that call wall, as they like to call it, to 200, 205, that moves that supply away, and it makes, sometimes after expiry, you can see big moves because suddenly the supply of options at a given level has just completely drastically changed. And that's really good information to know. There are a number of services that can help you with that. And it's become more important, right? We've seen the growth in volumes and options over the last 5 years. It's phenomenal, gigantic, massive. So these things that I'm talking about are more important than they were 10 years ago or 15 years ago, 20 years ago. They didn't matter, right? That stuff really had very, very little effect because it was so small relative to the market's natural size. Now it's becoming a little bit of, I want to say, the tail that wags the dog, but who knows when the options market becomes the dog? Probably doesn't. But these are becoming sort of formidable things to kind of consider when you're trading options in particular. So we have this nice structure here. So let's take a look at what we can potentially do. Well, let's go out to November. I don't want to trade AUK. We have that kind of, we're leading into the election. And certainly you're taking a bit of a chance at this point doing anything, putting on anything long because of that election uncertainty. I don't think the uncertainty is as big as people necessarily think. I think either way, you're going to get what you get. You're going to end up with a president. People think it's some sort of end of the world potential scenario. I'm pretty sure a president will come out of that election, and they're both going to want to either cut taxes or spend more money or whatever. It's not going to be great. Which is why gold and Bitcoin other trades look interesting, and inflation might hang in there. So let's take a look at Amazon. We can take a look at the chart. We saw that 180 is kind of a big breakout spot. So we could sell like a 180 vertical. We'll keep it, since the VIX is still a little bit high, I like to keep things to verticals as well, right? Because you don't know what can happen. Now, if we're at a VIX 13, 14, 12 kind of environment, I'm a little more inclined to just sell the put. Take that, because when you sell a put spread, you're going to get a lot less premium than you would if you had sold a put vertical. If you just sold the put, you're going to get a lot less premium with the spread than you are on just this. So for example, I can sell the 180 put for 435, and that's fine. But if I sell the spread, I'm going to have to buy the 325, the 175 against it for 325. That leaves me with like, what is that? $1.10 of premium. $1.10 versus 435. Now I have the protection there. That's very meaningful. If Amazon goes to 150 again, you're going to appreciate that put leg. But and that's why in a more uncertain environment, maybe we do the put spread. So we could do, say, so you could do a 180, 175 put spread. We call that a bull put vertical, right? It's a bull put spread because we're bullish, so we're going to sell the put spread. If we were negative on this, we might buy a put spread. So, but we're positive, so we sell that bull put spread and we receive a credit for that, right? So we receive a credit of $1.22. We'll lock it in there. And what we can do is we can use that credit to maybe buy like an upside call spread. So what if we bought like a 205, 210 for 143 for 140. There we go. So we're going to receive 122 for this. We're going to pay 140 for the call spread, right? So it's called a risk reversal. We're selling that skew. We're selling those expensive puts effectively, even though we're buying one put in that leg. Overall, we're selling that expensive put skew and that volatility. And we can see right here, 34 vol, 35 vol, and up here we can buy the 205, 210 for closer to like a 31, 30 kind of thing. And let's take a look at what this looks like. Here we go. So here's your risk reversal. You've got basically nothing much happens in here. You've paid an extra 18 cents for this spread. So your risk is $180 on 1,000 shares or a 10 lot of calls and puts. And down here, you could potentially lose 51.80 to the upside. You can make 48.20. So you have this sort of little bit of a lopsided view, but you're bullish on it, right? You don't put this on something that you're negative or neutral on. You're positive on this particular stock. And so this is what your profile looks like. Now, below 180, you could end up just saying, well, I'm going to own the stock. If it stays between 175 and 180, you end up owning Amazon, which you might be perfectly fine with. That's a level that it's basically held for a long time. We've talked about the fundamentals. We've talked about the valuation. We've talked about the storyline. So you want to be comfortable with all those things, right? If I get put a stock to me, I want to make sure that I'm okay with that stock. I don't want to end up owning something that I'm not comfortable with. So when you do trades like this, you always want to ask yourself, and even if you're doing a put sale trade on something, just a straight up put sale, the first question you should ask yourself is, do I mind owning this stock? And if the answer is no, then you probably shouldn't be selling a put on that particular name. Even if the volatility is extremely high and it's so tempting and everyone's talking about it in Discord and online and on Twitter and everyone's like, this is fantastic, it's going to be the next 10 bagger, make sure you're comfortable with that stock because you could very well own it. I always see selling a put as owning the stock. I just automatically see it that way. And that having that view is really going to keep you out of trouble. So here's your upside. You have a nice upside. You get capped, right? But you're basically putting this on for almost nothing. You either own Amazon at this point, or you take a little bit of a loss on the spread, but you effectively are able to participate in the upside for almost free. So you could almost make $5,000 to the upside on Amazon here on a 10 lot. Your margin is going to be very reasonable because you've made this a put spread. If you remove that long protective put, then of course this is going to be a lot more costly of a strategy because you're committing to owning Amazon below 180. That's a very different scenario. So the put spreads are a great way to kind of keep that cost of the position down. Very, very important to do. When you don't have a huge account, you want to keep it to things like this. So hopefully that gives you kind of an interesting little idea of how to do things. Now, what you could also do if you're super, super bullish, volatility is generally on the low side. You could almost go out to like June of 2025 and pick up just a call spread, maybe. Just do like a 200, 225. You get a $25 call spread for 10 bucks. And you've got a lot of time for this to work out, right? There could be a lot of shakeouts in between, but if you truly believe in this story and that Amazon is cheap, you could do pretty well there and make about 15 bucks on that spread if Amazon gets going by next year around mid-year. Or you could just take off the short leg and just go long some 210s. You could go long a 215 for 13.35. That's an outlay per one lot. That's going to be an outlay of $1,300. But you're going to get that nice big potential if this stock really starts to break out and go for it. So a couple different ideas, couple ways to play this. At this point, we're going to keep our risk reversal on. We put it on for almost nothing. I'm going to let it ride a little bit. And then once I get out of that, I'm going to look probably on a little bit of a pullback to put something else on again, right? We want to keep pressing when something's working out. We want to keep pressing, and if we still believe in that thesis. So I hope you guys enjoyed that, and we'll see you next time for the next video. Bye bye.